Okay, let's do it this way. I'll do my best to keep it as simple as much as possible, but I'll be taking you through some of the simple steps in forming a trade bias. When you're trying to form a trade bias, when you look at your chart, there's every possibility that you'll be seeing so many things. And believe me, the market is always doing something at every point in time. We believe in time, we believe in price, but as though that is not enough, you have to equally watch what you're expecting. Yes, in a buy setup, you could equally see a sell program. But the truth is that either of the program must be a higher probability. Yeah, maybe the sell might be a short term or a lesser probability than the buy, which means it might reward you with lesser peep than if you are taking the main trend. However, I'm not here to teach them how to take main trend trades or counter trend trades, but I just want to say, put us through one or two things on the formation of a trade bias Yeah. The truth is that um this is difficult. This is simple, but it remains one thing. If you start seeing it, you started seeing it. Yeah, once you have trained your eyes to see it, you've started seeing it. Um, you know, it gets to a point in your trading that no matter how complicated a chart wants to appear, by merely looking at the chart in less than, no matter how complicated a chart wants to appear, by merely looking at the chart in less than 3 minutes, you should be able to tell where it's going. Yes, you should be able to tell the next draw on liquidity, as easy as that. So that being said, there are majorly three things I put in mind when I'm trying to form a trade bias. Though based on experience, it just happens extemporaneously without much thought or premeditation. So that being said, let's go. Number one is market structure. Oh, not this. Number one is market structure. Market structure. Yeah, market structure. You should look out. You should have understood how to mark out market structure. If you don't really know how to do that now, I have a full playlist on smart money on this channel. Go through it and it will help you. So the next thing we'll be looking at in the market structure, you just need to ask yourself what's actually the dominant trend, who is in control. Now, being that I'm a lover of intraday trades, I only look at the daily. Only I only look at the daily one. Daily is the first chart I look at. Then I will narrow it down to the 1 hour. Then I go further down to the 15 minutes, and then I take it further down to the 5 minutes. Yeah. Now, sometimes you notice this kind of alignments between the daily and the 4 hours. So sometimes you can substitute the daily for the 4 hours based on how far they've aligned. Yeah. Then the next thing I look out for in a aftermarket structure, now maybe I've been able to determine that the dominant trend here, owing from the daily 1 hour, 50 minutes, and 5 minutes, but it's always sweet spot when you notice that 1 hour, 15 minutes, and 5 minutes are aligned. Let me take for example, they are all pointing towards the buy program. Like the dominant trend there is a buy. Now we'll have to narrow down our entry to the 5 minutes so we can get the least drawdown as much as possible. So that being said, the next thing I look out for is I look out for imbalance and OB. Imbalance and OB. That's order block. Why do I look out for this zone? The truth is that poorly traded areas, inefficient market price actions always have a way of getting retraced into in that very particular time frame. So I always love to look out for imbalance. Please take a very good note of everything I'm saying. I always love to look out for imbalance on the 5 minutes and the 15 minutes. Since this is an intraday trade, there is every tendency that the market is going to pull back into be it the mitigation block, or be it the vacuum block, be it the price gap, be it the breaker block, be it the other block. So in general, let me remove this OB and let me call it blocks. Yeah. Imbalance and blocks. So that block can be, as I said, order block, mitigation block, breaker block, vacuum block, price gap, and so on. Price must definitely retrace into it. Yeah, definitely. Then the second thing, okay, I missed this imbalance and other blocks. I said the reason I look out for them is it tells me possible level that price may retrace into. Now, if I can determine the possible level that price may retrace into, I try to determine my risk towards that reward. Yeah. I try to determine my risk towards that reward. And why do I try to determine my risk towards the reward? I try to do my best to make sure that I am not over risking, and I'm not taking a trade where the risk is not worth it in terms of the reward, because whether you like it or not, most of the time some of the trades you're going to be taking may end up in loss. But your ability to get through it all is if you actually have a good risk to reward ratio. No matter what hits you today, you'll bounce back. Yeah. I think I have a video that I did justice to that risk management and risk to reward stuff. Then the next thing I look out for in the market is this is a very, very important concept. Yeah, I pay very good and maximum attention to it. Liquidity. Now, in liquidity, let me just put this internal range and external range. So we'll look at the third time we'll be looking at information of trade biases liquidity. Why? After determining price levels that we may retrace into in terms of imbalance and blocks, now we should be looking at where price may be attracted to. Yes. Because when those inefficiently poorly traded areas are being retraced into by the deep pockets, which are the market makers, now when they've retraced into it, it's called a pullback. Yeah. Now, after retracing into it, there must be a level ahead that is pulling price further. And that level ahead, that's what we call the draw on liquidity. There is something ahead now that should be attracting price. The willing buyers, willing sellers. That's where we should be looking forth to exit our order. Now, in terms of this internal range, I may be exiting my order in an unmitigated order block, or in a higher time frame imbalance level. Now, in terms of external range liquidity, I may exit my trades in terms of previous highs and previous lows. Yeah, because we'll get enough sellers, buyers, orders resting on it, so it will be easier to switch our level. So that being said, when we are looking at this liquidity of a thing, we should ask ourselves, what's attracting price to go? Price is not just moving. Price is seeking liquidity. Yeah. Where it's actually heading. Then we'll ask ourselves again, which price level are we likely to trade into? Yeah. If you've actually followed most of my videos on the SMC playlist, you should be able to, because to the best of my knowledge, I did justice to all these. You should be able to finish them. Now, when this is done, you have to do three things. You decide your entry. When you've decided your entry, you decide a level where your bias will be considered invalid. So I love calling them invalid, bias invalid level. Yeah, level where if the market gets into, your bias will be considered invalid, and those level will be your stop level. Then the third one is your exit level. So this your exit level now is what we call the profit taking level. Yeah. So when in a trade, if you've successfully determined the market structure, the imbalance, the blocks, and the liquidity, the next drawn liquidity, and so on, you should now decide your entry. And after deciding your entry, the point of entry, you now ask yourself, at what point will the market step into and I will declare this bias invalid? That means if the market trades into a certain price level, it means that this bias will no longer hold. That's why I place my stop level. And I make sure that my stop loss in pips contains the exact amount of money I am willing to risk on that very trade. Now, my exit level, which is my profit taking level, I make sure it's a level that I am willing as a trader to exit the trade. Yeah. So don't be moved by maybe how, I don't think this is complicated, because for every concept I've listed here, from market structure to imbalance and blocks and liquidity, I have a full playlist on the channel that you can go through it, and everything there is for free. Just put in the work. So believe me, I tell people that trading is one of the hardest way to make the easiest money, because it involves your psychology. It appeals to your greed and selfishness, and above all, it reveals who you are to you. But the truth is that if you can get a firm grasp of what is required of you in trading, you can do it for a lifetime. So at this point, let's call it a day. Thank you.